Hello, I'm Ravi Dave, CEO of Yankee Capital Partners. I'm glad you can join us for this module on how we use data when investing in commercial real estate, and in particular, multifamily housing complexes. We're going to walk through the different data levels and sources we use and show how a thorough look at the data can minimize risk and help you get the most out of your investment. We're also going to look at some data sets for two actual deals and look at them side by side, which will be fun. In multifamily investing, we buy large, stable, income-producing apartment complexes based on our various data screens. Since it's difficult for someone to buy an apartment complex without millions of dollars, we pull investors together through syndication, granting access to investments that would not otherwise be possible. We then manage the purchase process, including debt financing, and pay investors their share of the rent collected. In the end, investors get to participate in any upside of the property as it appreciates over the holding period. In multifamily investing, there are three types or classes of apartments. A grade tend to be luxury and new builds. C grade tend to be older properties with sizable repair needs. And B grade is right in the middle, which is where we focus. These properties have low vacancy rates, supply workforce housing, and have the largest pool of renters. It's also the most resilient, as in times of economic downturn, residents of grade A units may trade down to a B, and in economic upturns, C residents can upgrade to B properties. As an asset class, core commercial real estate consistently delivers best-in-class risk-adjusted returns, while being safer than all other categories except for treasuries, which at the moment are experiencing record low returns. Through the use of data, we can be more educated and sure about a property, area, or geography to be certain it fits within our investment thesis. This involves a number of public sources, paid third-party aggregators, and offering materials from a broker. This is an example how we can slice and dice data to unlock trends in real estate. And in this example, we take a look at the tech industry. We can see that tech is the fastest growing industry for employment growth in the US, and that certain other US geographies are benefiting from the industry growth through job creation. These markets will undoubtedly have more housing demand as the jobs grow. So a look at this data set can help us stay ahead of the curve. With high-level screening, we can see which areas are excelling by any given metric and generally divide the US as shown here. At the state level, it's important to assess the tax situation and landlord laws, which will figure greatly into the business plan for running a multifamily asset. Landlord-friendly states tend to produce better returns in the multifamily space. For a metropolitan statistical area, or MSA, we can look at how a major city is scoring against our criteria and further dive into submarkets within the area. We can also look at demographic data. For example, here we see which MSAs are getting growing populations of the millennial generation, a large and growing group of potential renters. In submarkets, we get into the different areas and neighborhoods within the greater metropolitan area. Here it is extremely important to get into very granular local data to evaluate the health and trajectory of a submarket. Income, crime levels, and school ratings are some of the most important. One city area we like is the Dallas-Fort Worth Metroplex, based on our previous screens. We can also look at supply and demand data like this, in which we see Dallas must build 19,000 new apartments each year to meet the demand. This is a great bullish indicator for Class B multifamily. If we look at a deep dive into Dallas with these reventure charts, we can see that not only has household growth rate been top class, but that it also has been relatively resilient given the pandemic, which could spur further growth going forward. To get an idea of how we would score some of the deals that come across our desk, We'll go through 2 actual deals and show how we run some of our metrics. Sample 1 will be Castle Rock, 160 units of B-grade multifamily built in 1978. In deal 2, we'll be looking at Prestonwood, 194 units of B-grade built in 1979. With anything older than 1978, you can run into issues involving lead paint and asbestos that need to be remediated. So we stick with post-78 properties. Looking at median household income in this report run by Neighborhood Scout, we can see that both submarket incomes are relatively close to the national average. As a rule in our screening, we like to stay within $15,000 of the national median so both properties would pass the income test. In terms of crime, we look at violent property and an overall crime index. We generally like to see a crime index of over 50, 100 being the safest, but also realize that some B-grade complexes may be a gated community, and thus the property is safer than what's reflected in the report, which also underscores why a site visit to the property is a must. As far as looking at the schools, we generally like to see a quality score of at least 50, but obviously the higher the better. Good schools attract residents to an area and can be a driver of growth. It's also important to particularly focus on the scoring of elementary schools, since 2 and 3 bedroom B-grade multifamily tends to have a lot of young families. In this case, Prestonwood definitely takes the cake in school rankings. We look at grocery stores in the area and coffee shops, since access to food and commercial activity are important for a submarket. We also know Starbucks caters to a well-heeled consumer, so the several Starbucks here will indicate a good and stable area. Prestonwood also shows good signs of commercial activity, including a large supermarket nearby, and again, several neighborhood Starbucks and boutique coffee shops. A strong retail presence is particularly important to a grade B multifamily, as it can be a source of employment for residents. Here we can see that Castle Rock property is below the market in asking price and about in line with market rents. The red flags to me in this case lie within the orange bar charts, where we can see decreasing market activity on the left and stagnant decreasing rent growth right down to about 1%. When we look at Prestonwood, we can see that both the asking price and rents are well below market. And that gap is where we can really maximize value by getting back in line with the overall market conditions. The market volume in orange on the left has been consistent and healthy, and we can see rent growths have been holding steady above 2%. These charts show that there's a real opportunity to catch up in pricing in the neighborhood with attractive returns. In the end, sample deal 2 ticked all our boxes. It was a gated community, so we were able to be tolerant in our crime screen, while the income in schools also passed. The historical data also showed that this property was lagging the market and presented a strong growth quality. Our next steps here would be starting an underwrite and connecting with the selling broker. In investing, there's no such thing as a sure thing. There are always risks involved. But what Yankee Capital Partners does in its use of data analysis mitigates this risk. Through these various screens and robust reporting, we can be very precise in our assumptions and path forward, leading to best-in-class risk-adjusted returns for our investors. Thanks for watching this module. We hope you found this video helpful. Please feel free to reach out to us if you have any questions or want to discuss this topic further. Don't forget to come find us on our social media pages for more updates or browse our other video modules.